I recently closed out a trade with a massive 10% gain, which provided a significant boost to my overall portfolio. You might wonder, how did I know the chart was destined to move upward? It all came down to identifying this specific candlestick pattern right here. In this video, I'm going to share my absolute favorite candlestick patterns, just like that one, which I utilize on a daily basis. My goal is to help you read and understand chart patterns more effectively, predict market direction accurately, and become a more successful trader capable of making plays just like this. Let's get straight to it. The engulfing candle. One of my most frequently used and highly reliable candlestick patterns is the engulfing candle. I have featured it in many of my previous videos because it is such a potent signal. It can pinpoint the exact moment a reversal is about to occur. So, what exactly is an engulfing candlestick? The name essentially explains the concept. It is a candlestick in the opposite color of the previous one that simply engulfs it entirely. A bullish engulfing candle opens at or lower than the close of the previous candle and then closes above the previous candle's open. Visually, it is larger than the preceding candle on both ends, making it appear as though it is swallowing or engulfing it. Let me show you an example. Here, we identified a very strong support level where the price has bounced multiple times, proving that the market respects this zone. When the price returns to this support, we expect another bounce. However, rather than just assuming the support will hold, we wait for a bit more confirmation. That is when we see a bullish engulfing candle form. It completely engulfs the previous red candle right at the support level. This is an extremely bullish sign, giving us the confidence that the price will move up, so we enter the trade and look at the results. It is important to note that just because you see a bullish or bearish engulfing candle doesn't mean the price will reverse 100% of the time. You should never trade purely based on candlestick patterns alone. Instead, treat them as hints regarding the market's next move rather than absolute decision makers. Use them in conjunction with other tools like support and resistance, technical indicators, and broader strategies. Let's look at a bearish example. Here we have a similar setup, a strong resistance level that price has respected multiple times in the past. As the price approaches this resistance again and starts to decelerate, we see a bearish engulfing candle form, completely swallowing the previous green candle. This rejection at resistance is a great signal to go short, and as expected, the price drops. The momentum candle. Next, we have the momentum candle. This one is much easier to spot than the engulfing candle simply because of its impressive size. A momentum candle is a bar that is 2 to 3 times larger than the candles that came before it. This specific candle can be insanely powerful because in most cases, after it appears, the price will continue to trend in that same direction. This makes the momentum candle a fantastic entry signal. The most efficient and effective way to use this pattern is in choppy markets, where the price is moving sideways. If you ever observe a sideways market and then a massive momentum candle emerges, being 2 to 3 times larger than the previous bars, you can be quite certain the price will continue that way. Why does this happen? Think of it this way. In a sideways market, there are many short sellers stuck in their trades. They don't want to exit yet, because the price is ranging and could still move in either direction. They have their stop losses set right above the resistance. This means there are tons of traders with stop losses clustered in this area. If a sudden price movement hits this liquidation zone, all those stop losses are triggered, adding fuel to the fire and forcing the price to keep moving up. Furthermore, when price breaks out of a choppy range like this, it usually initiates a fresh trend in that direction. The strategy is identical for shorts. If there is a choppy sideways market and a huge red candle appears, 2 to 3 times larger than the previous bars, it is a great indicator to enter a short position, as the price is likely to continue downward. The multiple candlestick pattern. Next, we have the multiple candlestick pattern. This is one of my personal favorites because it tends to hold very true on the charts and is remarkably simple. All it involves is identifying 3 or more consecutive candles that have wicks pointing in a single direction. The more candles you see, the better. I prefer to pair this pattern with support and resistance levels. Look at this chart. What do you see? First, we have a key support level where the price has bounced multiple times. Then, we see multiple candles with downward pointing wicks right at that support. These downward wicks tell us that sellers are trying to break the support, but buyers are fighting them off and winning repeatedly. This confirms the strength of the support and suggests a high probability of an upward bounce. Remember, the more candles you see rejecting the level, the higher the probability that the pattern will be respected. We can apply this to short examples as well. When the price moves up to resistance and you see multiple candles with wicks heading upward, it indicates that the price really doesn't want to break higher. This gives us a solid short entry. We enter here expecting a reversal, and the price drops. The doji candle now. Let's talk about the doji candle. A doji is a candlestick with an extremely thin body and wicks on both sides. It is crucial to understand this candle because it serves as an excellent indicator of an impending price reversal. Essentially, this candle represents market uncertainty. The bulls and bears are in a stalemate and the market is facing resistance in its current trend. Whenever there is uncertainty or resistance, the price will more often than not head in the opposite direction. For example, imagine the price is dropping quite hard. Then, a green candle appears that happens to be a doji. This indicates that sellers are starting to be less confident and buyers are starting to enter, making this a great potential place to enter. What I normally like to do with dojis is wait for 1 or 2 follow-up candles of the same color to confirm the reversal. In this case, I see a green doji. I wait to see 2 more green candles heading upwards, telling me I can be confident that the price will continue in that direction. There are several variations of the doji candle that you might encounter. Regular doji, the classic thin-bodied cross. Long-legged doji, same as the regular one but just has larger wicks. Dragonfly doji, a small body at the top with a large bottom wick. Gravestone doji, a small body at the bottom and has a big upper wick. All of these tell the same exact story, a reversal in price. Hammers and shooting stars. The next candlestick we will examine is the hammer. A hammer typically features a decent-sized body and a long lower wick. This candle tells us that sellers got the price all the way down to here, but the buyers absorbed all that selling pressure and raised the price all the way back up. This is usually an extremely bullish sign and can tell us that the market will continue to go in that direction. Very similar to the hammer is the shooting star. A shooting star is essentially just like the hammer but with the long wick on the opposite, upper side. You should be playing this just like the hammer, where if you see a shooting star candle like this, you can have a good suspicion that the price will start reversing. The tweezer pattern. The next candlestick pattern is called the tweezer. This pattern consists of a red candlestick followed immediately by a green candlestick, both of which have similar wicks on the bottom. If you see this pair, you can have a pretty good idea this chart is about to move upwards. Let's look at an example. Here we can see price is about to hit this support. We see a red candle with a wick on the bottom right at the support. Then we see a green candle that also has a wick heading downwards. This is telling us that the price is respecting this support and is now getting some momentum upwards. This would be a great time to buy, and look what happens, price raises. The opposite is true for a bearish signal. You want to see a green candlestick, then a red one, both having wicks at the top. We see that exact pattern here, and boom, price falls. The Marubozu. The final candlestick pattern I want to discuss is the Marubozu. A bullish Marubozu is a large green candle that has no wicks at all. It's basically just a big green rectangle. The cool thing about this pattern is that it serves as a good indicator that price will keep heading in the same direction it's going. You will typically see this candle in the middle of a trend, confirming that the trend will keep moving upwards. Let's see an example. Here we saw a price reversal. Price is starting to head upwards. Then we see a bullish Marubozu candle. Notice how the candle has no upper or lower wicks. This means that the lowest price of this candle was the exact same as its opening price, and the highest point of this candle was the exact same as its closing price. This is telling us that buyers have complete control, and we can almost certainly predict that price will continue to go upwards, and look what happens. It does. The bearish Marubozu follows the same idea. It is a red candle with no wicks. Here we see the price had a reversal, then we see a bearish Marubozu candle telling us sellers have control, and the price will probably keep moving downwards. We enter making this a winning trade. Bonus tip. Automatic pattern detection. Now, it's time to give you a bonus tip for all those who made it to the end of the video. This is my way of saying thanks for watching all the way to the end. Even though you should probably try to memorize these patterns so when you see them you can have an idea of what the market is going to do, I completely understand that it's hard sometimes to look for them or remember what they look like. Well, lucky for you, there is a way to make it so you can have your chart tell you exactly where a certain type of candlestick pattern occurs. This makes it really easy for you to spot them, and you don't even necessarily have to memorize them. To do this, just go to TradingView, click the Indicators tab, and type in whatever candlestick pattern you want. For this example, we'll do a bullish engulfing. Simply click it, and TradingView will notify you on the chart when the bullish engulfing candle appears, making it extremely easy to spot when it happens. You can also add multiple candlestick patterns to your chart so you can identify when any of them occur. I hope you guys got some value out of this and you learned something new. If you did, I would really appreciate it if you took 5 seconds out of your day and liked this video. The one and only problem, trading with candlestick patterns, is false breakouts, where a certain candlestick pattern occurs, but the price actually does the exact opposite of what the pattern predicts. If you want to learn how to avoid situations like this, watch this video where I go over my secret strategy to avoid false breakouts. Thanks for watching, and I'll see you guys next time.